Welcome back to the show. I hope you've had a good week. Today we are also changing up the show so that it is more transparent so that you can see an updated version of all of my holdings, which stocks I'm watching, which stocks I'm buying, the biggest riser and faller, and introducing the new stock tip of the week. The three top topics of the week start with the CEBR, the Centre for Business and Economics Research, which have estimated that after the furlough scheme ends after October 31st, that 1/3 or more than 1/3 of the people on this scheme will likely be made redundant. Therefore, this is going to push up unemployment. The Guardian themselves have stated that they believe this will mean that our unemployment rate will be above 8%, which is a figure that's not been seen for the last decade. In my personal brief opinion, I believe it might be worthwhile to save up cash, build up those emergency funds, even if you've only got 2 weeks, at least get something there now. And also, if you're not worried about the emergency fund, that you should look into your stock holdings and feel that if the lockdowns were to continue, no more furlough, will these companies be okay? Will they survive? Or will they be struggling? As it might be a good time to rebalance your stocks. The doom and gloom continues this week if you do not like the idea of a no-deal Brexit, in which our Prime Minister Boris Johnson had announced that Britain should get ready for an Australian-style Brexit. This means that whilst we were reaching for a Canadian-style Brexit, we're now aiming to just hopefully have free trade agreements globally. But this also means that tariffs could be reintroduced with Europe, therefore meaning that there is import and export fees, which will eat into the profit margins of those that perhaps make a majority of their income from transferring of goods. In turn, sterling had risen, and you may think this is a bit ridiculous for it to rise. However, I believe it's due to the increase in certainty. There was a lot of uncertainty around sterling, and since the start of the Brexit idea that sterling had been priced down. I feel that no matter what, that at some point this is going to start increasing over the short to medium term, simply because once we get all this behind us, there's more certainty once more. And therefore that's why I have all of my exposure in UK equities, simply because I do not want to be taking the risk of currency fluctuations. I want to invest in the pound as it is strengthening. Typically a rising pound does mean that stocks do fall, although I'm confident that these holdings will also be able to benefit from it. Hence my exposure to smaller and medium cap businesses. I've not spoken too much on one of my holdings, London Stock Exchange Group, on the channel, but that's because currently they're undergoing negotiations to purchase Refinitiv. Just recently, they had sold their Milan Stock Exchange for 4.3 billion euros. And in 2007, they'd actually acquired this same stock exchange for 1.3 billion euros. So you may think, oh, that's an excellent profit. They've just traded it. Well done. But there's actually another reason for doing it. And this is to increase their chances of getting the Refinitiv deal secured, because at the moment there is some controversy. This is because London Stock Exchange, after acquiring Refinitiv, would make it very likely that there wouldn't be fair competition in place, and therefore the EU regulators were uncertain. Hence why, to appease them, London Stock Exchange Group had sold this stock exchange to therefore hopefully be more in favour of getting this. I think this would be a massive change for the company should the Refinitiv deal be successful, and it really could change how their profit margins are and make them into probably one of the best UK stocks available. And they believe that this will increase their chances for the £21 billion deal for Refinitiv to be successful. In the stock market this week, according to Google Finance, the FTSE 100 is down by 1.49%, the FTSE 250 is down by 1.36%, and the S&P 500 is down by 0.41%. And this marks the third consecutive week that my portfolio has underperformed the markets, as it has dropped 2.74%. Once more, I'm not concerned at all about the short-term volatility, and this is largely due to my high unbalanced weightings to certain stocks in the portfolio. This means if they drop, a lot of my portfolio is impacted by this, even if a majority of the companies actually did well. I'm hoping that as time goes on, I can balance these positions as I put more money into the portfolio, and therefore it wouldn't be so biased to one stock. However, this does mean that whilst I was very close behind the S&P 500, I'm now trailing it by 10%. Although I'm not concerned, I do think I can catch back up in the future when the elections come along and uncertainty prices down their stocks perhaps. So what is the top gainer of the week according to Google Finance? Well, this week, Ashtead Group, or the ticker symbol AHT, or more commonly known as Sunbelt Rentals, which leases equipment to the construction, industrial and agricultural sectors, had actually increased by 2.13%. This stock is tied heavily to the global economy, but because of their high exposure to the US, this means that when the US does well, Ashtead Group typically tends to follow in the trend. Although this week it isn't because of that, it's because of a regain in investor sentiment, which it had been struggling for over the last month. And for the last month or so, it had also been trading sideways, so it's nice to see it nearly break all-time highs. My holding with AHT consists of 45 shares, which are now up 16.11%, or more specifically £185. At the moment, I'm not buying any more shares of the company, simply because this is probably one of my most balanced positions in the entire portfolio, and therefore there's no reason for me to top up. With them also reaching more higher and higher peaks, it makes it harder for me to find a good short-term value, and so what I will do is, whilst the current allocation is 9.5%, if this drops below 8%, I will be topping up this position, but in bulk. I'm not going to consistently put small amounts of money into this stock. I'd rather just lump sum it on a weakness. So which stock was the biggest fall of the week? And if you keep up with the stock market and more particularly my channel, you likely already know. This stock is Boohoo. They provide fast fashion clothing which is vertically integrated, meaning they control all stages of the business production. This week, Boohoo shares have dropped by, wait for it, 10.4%. And quite a few of you have reached out to me asking if I've topped up, changed my position at all, and I have not. I still hold 2,000 shares of Boohoo, in which I'm up 28%. This gives me an excellent margin of safety. However, as I mentioned in the last episode, I will be interested in building this position, especially if it drops below 280 pence, although the price to pay for getting more stocks in this investment would be selling out of some of my other holdings to therefore inflate the position to 3,000 shares. Although the issue is that my cash position is very weak at the moment, and it means I could probably only get 200 to 300 more shares if I combined all of my finances and push towards it, and therefore that's the next motive for this. I'm hoping over the next few months that my cash flow, or my personal cash flow, starts to increase, which it likely will, and then I can use that money to save, build up my emergency fund and build up my cash position for the portfolio. And I will likely be topping up if this drops below that said figure, simply because Boohoo is a high octane growth stock. In late November, I'm going to be revealing all of my current income streams, including my revenue from YouTube. So if you're interested in that, do not forget to subscribe so that you do not miss out. At the moment, I'm watching two of my stocks in the portfolio. The first one is one I mentioned earlier, London Stock Exchange Group. With this ongoing deal for Refinitiv, this means that the price can be changing quite often. There's currently a lot of uncertainty in this stock, and I feel that if London Stock Exchange successfully acquires Refinitiv, that this stock therefore will have that risk priced out of it, and therefore it should go up somewhat even if it trends over the longer term. Therefore, I am looking for opportunities to top up my position, although I'm trying to be cautious about it. This is because I do not want to overexpose myself to that risk. Chances are, if they unsuccessfully get Refinitiv, which is only looking like a minority percentage chance, it could seriously impact and eat into the returns of my portfolio, as this stock will likely drop down. Although because of it, shares of London Stock Exchange Group have been stagnant for the last few months. Currently, I've held it since late July, and I'm only up 4.82%, which compared to my other holdings isn't that impressive, although if this was annualized returns, then it's not too bad. I only hold 15 shares currently, and I will likely be looking to top up once there's more certainty or a short-term weakness, so that therefore I can lower my risk or margin of safety. The other stock I'm watching is one of my favorite stocks in the whole of the UK, and that's Games Workshop. Lately, they've been going from strength to strength, and their share price just keeps going up. I'm a little bit concerned about this, and I do think that it is due for a minor correction in the future. Therefore, I'm looking for a short-term opportunity. This is a stock that I would likely try to put consistent sums of money into, although at the moment I've not done this. Currently, I hold 30 shares of Games Workshop, which is up 28%. They are an excellent income stock and make up a majority of my dividend income in the portfolio, as they are also a quarterly payer. Next week, on the 21st of October, I am pretty sure I should be receiving an additional dividend from Games Workshop of around £15. Whilst I am the type of person that likes to regularly invest consistent small sums of money into my favourite positions, I'm not really going to be doing this with Games Workshop for the time being, and that's because I see higher value in the stock that I'm currently buying. If you're wanting to take control of your investments, why not grab free shares worth up to £100 each by signing up to Trading 212 using my link in the description down below. You sign up, click the link, deposit £1, and we'll both be eligible for a free share. And so if you are truly interested in stock picking, then don't forget to click that link. So which stock have I been buying this week? And it should come as no surprise, as it is a technology stock that I have been acquiring for a while now. Although what happens is that typically Softcat seems to rally in expectations of results. Once the results hit, it goes even higher, but then it starts to decrease again. So on that decreasing trend since their last results, I had been topping up and buying into that position. It's given me 90 shares, which I think is a good, strong position to have, although I would like to get it to well over 100 shares by next week. Currently, this is my worst performing holding, which is only up by 0.53% or around £6.53. The reason I have been buying Softcat is because they are a business that benefits from the continued outspread of this pandemic, which sadly I believe will continue to happen for the next few years. I'm not that bullish on an idea of a vaccine that is successful, and therefore I'm not going to hedge my bets on that idea. Rather, I'm going to assume that one of the worst cases will happen is that lockdowns will be more common and that we will still have to remain socially distant. This means that businesses will need to adapt or they will not survive. Therefore, I believe many businesses will be looking to upgrade their infrastructure to more technology-based ideas so that they can be more resilient and continue to grow. Therefore, Softcat is in an excellent position to offer this to businesses as they are an IT added reseller and IT infrastructure provider. I believe that their amount of customers will increase, or perhaps the customers that are coming to them are looking for more substantial upgrades and therefore they're making more money. This is combined with the fact that they will be resuming. It is largely expected that they will resume their dividend and pay the one they missed during when they cancelled it in the pandemic peak in March. As part of the changes to the series, I'm now going to be doing a share tip of the week. I originally saw this idea on a website called the Share Center, and what they do is each week they provide a new stock in which they think would be the share tip of a week and a reasonable purchase to get in your portfolio. So I'm planning to pick a stock that I think would have good short-term value that wouldn't be a bad addition to your portfolio, although I do want to disclaim that this might not necessarily be a stock I'm buying myself, and therefore I'm going to look for stocks that perhaps I've not covered before on the channel, state my reasons for why they are worth buying, what they are, why you would buy them, and the level of risk involved in them. The share tip this week is a value recovery play with a medium risk in which the company is currently unprofitable. They had cut and suspended their dividend earlier in the year, although it never really was a great dividend payer. Whilst yes, they had consistently paid it for the last 8 years, they hadn't actually grown it, and it meant that this stock was only yielding around 1 to 2%. And I don't blame them for cutting it, as this is an industry that is very much struggling with the ongoing situation. This stock has a market capitalisation of £930 million, listed in the FTSE 250, and has an individual shareholder that takes up 27.38% of the company's share pool. This stock is in the consumer services sector and the ticker symbol is JDW. Very recently they announced their results in which for the first year since 1984 that they are actually loss-making. Whilst their short-term debt levels are very high and therefore could present a risk, and for the next few years in which I anticipate the pandemic to continue as more, this could certainly mean that there is some level of risk to this stock. However, I do also feel that we will be going into a very deep recession. This is a stock that has consumer staples as it does sell alcohol and food. Therefore, I feel that simply because they are better placed than their competitors, that they can come out of this a stronger company after the medium term. I think Wetherspoons are well known for providing food and drink at cheaper prices than their competitors, and therefore in recessions when people are much more money conscious and would like to save more, get more value for their money, then they're more likely to go to a Spoons. The sad part about this is it does likely mean that a lot of the smaller individual or independent businesses or pubs are likely to go under, but this could mean that Spoons, if they do choose to take up more debt, which I'm on the boat about, but what they could do is acquire some of these pub locations and therefore over a longer term trend benefit a lot. This is combined with on Friday they had dropped by 19.53%. They are better placed than their competitors simply because they can do this at cheap prices, and the only way for others in the industry to compete is by therefore risking their profit margins, in which since Wetherspoons is such a big business and is able to import these goods or get these goods at very cheap prices, it would be very difficult to achieve. Although for at least the next year, where I believe there'll be many localized lockdowns to happen and a reduced number of customers going inside these pubs, I do think this is really going to test their ability and their balance sheet. If you're interested in how much I made from 6 months of stock picking, then click the card at the top right of the video. For those of you that have made it to this part of the video, I'd love to hear your opinions on what you think of the share tip of the week and the new format. Thank you for watching. This is the Osborne Foreman Show. Stay safe.